What's going on, team? Welcome back, and today we're going to be toying with the moving averages. So we're going to talk about the exponential moving average and the simple moving average. What is the difference between them and how we can apply those in our trading. As always, remember to leave a like, subscribe to the channel, and leave a comment if you want to see next. Also, if you want to connect with me and check us out trading live, go click on the Discord link down below. So what is the moving average? So all the moving average does, it takes into account whatever the total value of the price that you set for the time frame and just divides it and plots out a point for you. So that's all really moving averages do. But the difference between the simple and the exponential is that the simple moving averages takes into account everything equally. So let's say you have chose a time frame of 9, takes the last 9 candles, adds them up, divides them all equally. While an exponential moving average will give much more value and strength to the most recent data that it has. So you'll take into account the last few candles, much more heavier than the latest 3 candles, right? So that's the main difference between the moving averages. So think about an exponential moving averages, like the name says, being much more reactive and much more exponential, can go up and down much faster than the simple moving average will. So there's pros and cons on both of them. So let me show you guys all first in a picture. So if you go to studies, I'm going to show you guys on Thinkorswim, this is how you set them up on Thinkorswim, and depending on the broker you use, I'm sure there's a way for to set them up there. Just mess with it. Every broker will have the moving averages because they're so important. So you go simple moving average, double click it there, and then moving average exponential, and we're gonna set both of them as the time frame of 9. We're just gonna change the moving average exponential from the color from the purple. I usually have mine as purple, so we're gonna keep the SMA, these examples will be blue, and the purple will be the EMA. So if we zoom in, as you guys can tell, look how the EMA moves much closer depending on the price action more recent. So you see how it's so much more exponential, while the SMA acts a lot more slow. See how far it is compared to the EMA. And boom, the price drops, EMA drops really fast with it. So that's on a daily time frame. I also want to point out to you guys that depending on the time frame you're using, the values are going to be different. So as you guys can see, 236, this is an example on PayPal on the daily time frame, will be 236 is our SMA 9, and our 233 is going to be our EMA. So let's say we change that to a 5-minute time frame. Look, now the blue is 234 and the EMA is 234.10. So 234. This is 236, right? So as you guys can see, the price will change just because the last 9 candles on a daily are much different than the last 5 candles on a 5-minute chart, right? So that's why it's important using the EMA on time frames that are used by traders, because they're so well respected and they're so well used. So some good time frames that we use is 5, 15, the 1 minute, and the daily time frame. So in our strategy, you guys know that we use the EMA 20 mostly for a stop loss. So why do we do that? So let me show you guys on a penny stock that we traded recently, ACY. You might have heard of this stock. It ran about 3,000%. Let me show you guys the daily. Oh, the 1 year, 1 day. Look how it ran. So it ran huge, all the way up to almost $40. We traded this in our Discord from $5, right? So why would we care more about using an EMA in this example than an SMA? Well, as you guys can see, from all this before we made that huge run that we started trading it, the stock barely did anything, right? So the stock barely traded, barely did anything, there's no volume, so why would we care for this time frame? We're trading the intraday for momentum, for high volatility. We don't care what happened when the stock didn't do anything. You guys can tell just looking at the chart. Do we care about all this information here? Do we care about it? We don't. But if we go now in the 1 day, 5 minute, boom, we care about this. We care about this high volatility, a lot of volume, a lot of momentum going on. So we care about just what's going on intraday. So remember, we use the exponential moving average intraday. So if we're trading something intraday, looking for exact entries, exact exits, we're most likely going to be using the EMA, and that's what we do for a strategy. And we use this strategy to mostly look for the EMA 20 is usually going to be used as a stop loss. Is it always going to be used as a stop loss? No. Can we look for EMA bounces or EMA breaks for potential entries? Yes. I changed the EMA 20 to show you guys how we use it as a stop loss in our strategy, in our momentum-based strategies. You guys can see the stock is above it, and the EMA 20 will be your stop loss, right? So we're entering the trade as close as possible. You can enter around here, wherever you get in. As you guys can see, the stock never breaks under the 20 EMA. Sure, this candle went down, but it recovered real fast, right? So it didn't close, we didn't exit, we started the trade. Here it closed under, we're out. As you guys can see, the stock becomes, it's still a little bit above it, fighting it right on it. It's trading right on it, fails. So we're out. You could have, here, goes back up. Finally, the candle closes above it. You could have potentially get back in. 20%, you could try the EMA break there. And again, goes under it and it trades down. So you guys can see how the EMA 20 will show if a stock is bullish or bearish and how we can use it to get in or get out of the trade. If the stock is under the EMA 20, it's trading under the EMA 20, that means it's more likely going to be more bearish. It's going to continue trending down. So why would we want to be in that stock, right? We'd rather get out and maybe look for a potential entry later if it breaks above it. So we want to cut our losses soon and try to keep our losses at a minimal. I always tell you guys this, how can we control how much we're going to make if we can't even control our losses? If your losses are indefinitive, your wins will also be the same, right? You don't know how to control your win-to-loss ratio, your risk to reward. When you're entering a trade and mapping out what your entry is, you should also mapping out what your stop loss is going to be. Having a stop loss is just as important as having profit targets and entries. So now this is going over the EMA and how it's useful on an intraday time frame, right? So now what if we went to a daily time frame, looking for swing plays or looking for long-term holds? So the EMA wouldn't be as useful. Why? Because it's taking into account not the overall trend on a daily time frame, it's taking out whatever the last few days have been much more heavily, which we want more if we're going to be swing trading and holding it for a few weeks, maybe even months. We want more of a trend. We want to see what is the trend evenly over time of that stock, right? We don't want just what's the trend within that little few days or little few days of few weeks, depending on your strategy, is to be what's our deciding factor. So let's go, for example, on Tesla. So Tesla, we're going to change the studies, edit studies. We're going to get rid of the EMA, and we're going to be adding 4 different SMAs. So I'm going to show you guys which ones those are. So this is what we use for our swing trade strategy. 1, 2, 3. Come on. 3 and 4. We're going to change this from a 9 to a 20. We're going to keep that blue. 20 to a 50. And why are we changing to these exact time frames? As I mentioned to you guys before, these time frames are the ones that most stock traders are looking at. So they're important, they're relevant. Remember when we talk about area of value? Well, these are going to be the biggest, more potential area of value. So that's why we're going to be using this time frame. So we're going to change the 20, the 50, the 100, and lastly the 200. The larger time frame, depending on your, it's going to show the. So the further it gets, it means the trend is stronger and stronger. So as you guys can see, Tesla went all the way down to 200 and it bounced perfectly 200 to peak COVID, right? People said this is a good place to get in. And look how farther it keeps getting from the 200, just gets more bullish and more bullish, right? So we want to trade stocks that are above all of those. Why do we want to trade stocks that are above all the main SMAs on a daily time frame? If we're going to be swinging it, right? So if we're going to be swinging a stock, we want it to be the most bullish as possible. So we want to trade stocks that are above everything, right? So let's say we enter the stock around here. As you guys can see, on a time frame, the stock was very bullish. So it keeps going up, right? And we do, of course, want to have a stop loss. So our stop loss would have been under the SMAs. And, depending on your risk to reward, whatever you're looking for, you could have entered even here. Look, it bounced perfectly in the 20. So you could have entered and bounced on 20, stop loss under the 20, and traded it like that. You also want to look for stocks that bounce on this typical time frames, right? So you can see Tesla has bounced there before, has bounced on the 20 SMA before. Here it's cracked above it, 1, 2, 3. So you can just see how this 20 SMA is very powerful area of value for the stock, right? Same thing with the 50. Look, it bounced on 50 once, twice, and it's another, once it crossed above it became very bullish. So you look for this area of value, things that we always talk about before, right? So we want to trade stocks that are above all of it because the stock becomes more bullish. Look how much more bullish the stock got once it was above it. If it's below it, there's a potential high chance the stock keep trading down, right? Look, if it goes below it, it's going to keep trading down. So why are we going to enter the swing trade when the stock is still trading down? We want to wait for confirmation. We want to wait for potential entries. So we're going to want to enter and ride the momentum up. Remember, we want to ride the momentum. We don't want to start a momentum. We just want to take advantage of wherever the momentum is for that stock. So that's what we have to do for a swing trades. Look for a stock to be above all of those and look for potential entries as close as possible, so that it's safe for you to get in. And remember, we enter swing trades, we'll find them on the daily time frame, but we do enter them on an intraday time frame to look for exact points, and then we will switch over to an EMA. So that's why having multiple charts with different indicators is so useful, so you can do those kind of things much faster, right? But always remember, guys, as I mentioned in every single video, in every single class, I tell you guys that MAs is an indicator, right? So do we trade based off of just one single indicator? No, we never do that. Everything is part of a puzzle. We have a strategy, we implement a strategy. Now using the EMA 20, in a 1 day, 5 minute time frame is part of that puzzle that, hey, that gives us our stop loss, that gives our potential entry. So that's one puzzle out of whatever you're looking at that gives us, okay, this stock is safe to enter, it's safe to exit, I know my exit, I have a good risk to reward ratio, right? Because if you set your stop loss, then you're like, okay, stock is at $2, I want to expect the stock to go to $2.50, my stop is at $1.80, that's good risk to reward, right? You're risking 20 cents to make 50 cents, correct? So that's why understanding the puzzle and knowing what all your indicators mean and having a specific strategy will make you a consistent, profitable trader over time. So understand your strategy, understand your puzzle, understand how to trade it, and I'll see you on the next one.